As we learned earlier in our video series, savings is setting money aside for future use. When we've met our savings goal, then it's time to think about our future. Then it's time to think about putting money to work. We want to invest our money so that it grows. Investments are assets purchased with the goal of providing additional income from that asset. However, when we purchase assets for growth, nothing is guaranteed. There is a risk that they will not grow as we planned. There is a risk that assets might even lose value. In fact, we could lose it all. So the first important investment lesson we must learn is that, unlike insured savings tools, investments are not secure. There's a chance that some or all of the money we invest could be lost. We also need to learn that investments cannot be easily converted to cash and used for other things. They are less liquid than other savings tools. In fact, with some investments, you may have to wait a long time, even years, to access the funds. Investments help us build wealth because we choose them to potentially have higher rates of return than savings tools. A rate of return is the amount of growth that we expect and ultimately get when we put money to work. Now remember, there's always some uncertainty, there's always some risks with investments. When we invest money, we hope to earn higher returns, but we're also going to have to accept more uncertainty. We don't really know what the risks are going to be. Risk is the chance of loss. Risk cannot be entirely controlled. Some savings tools, like insured bank accounts, are essentially risk-free. Around the world, investments in United States Treasury bonds are considered risk-free. The United States is the only nation on earth with a perfect record paying its debt. It is always possible investments will fail to pay the expected return. In fact, they may fail and not pay any return at all. They may even become worthless. So it shouldn't come as a surprise that when we are willing to accept higher risks, we expect to have an opportunity to earn higher returns. There are different types of investments that offer differing returns and different risk levels. But it isn't the purpose of this video to go into all of those options. Let's begin by keeping this simple and talk about the most basic way to balance risks and returns. When people begin investing, often the best strategy is to pool their money and invest in financial tools where more people are investing and sharing the risks. There's safety in numbers. When we pool assets with others, we can find ways to choose investments where the risks of any one part of our investment portfolio is not dependent on the risks that are placed elsewhere. This is called diversification. We can choose investments so that if some of our assets are not performing as we have planned, some other assets are likely to be doing well or maybe even better than we planned. This idea isn't new. Most of us have heard of it before. It's the idea of not putting all your eggs in one basket. When getting started, the best way for most Americans to invest is to place money in funds so that our wealth is working with the assets of other people. When we start investing, perhaps we don't have enough assets to fully diversify our risks, but we can work in investment tools that share assets across a group of investors. This allows small investors to properly and fully diversify risks, just like large investors or investment banks do. The key to investing money is to be mindful of risks and returns.